A geopolitical shock just punctured a multi-trillion-dollar monopoly narrative that is SpaceX. Market movements are inherently multi-causal, but the mechanical transmission of this specific valuation shock exposes a structural flaw that no amount of portfolio diversification can fix under current rules. We are watching a theoretical financial risk play out in real time. A Chinese reusable rocket recently executed a successful net capture landing. It is a direct, existential challenge to SpaceX. The market reaction has been brutal. The stock is crashing. But the stock crash is just a tech story. The reason this is a retirement story is because of an invisible regulatory mechanism you have probably never heard of. Here is exactly how a rocket landing in another country is having adverse effects on Australian retail superannuation funds. You are probably thinking that a distant tech crash has nothing to do with your local retirement account. Turns out, it has everything to do with it. The entire valuation was based on an AI play. The narrative that was SpaceX would launch AI data centers into space to satisfy an insatiable demand for compute power. But just because you can build them does not mean that the market will absorb them at these prices. Investors are actively selling off long-dated AI debt. They're experiencing growing fatigue over big tech's massive borrowing spree. This financial distortion is mirrored in the physical world. Billions are being diverted to energy and water-intensive AI data centers, starving the renewable energy transition of the patient capital it desperately needs. When you listen to the cheerleaders on Wall Street and Silicon Valley, they talk about how space exploration is the future of humanity, and that the potential upside is limitless. It sounds brilliant in a venture capital pitch, but in the real world, it is a fundamental disconnect from reality. SpaceX knew that its valuation was absurd, so they engineered a mechanical workaround. They jammed their way into major global share indices. The strategy was simple: force passive index funds to buy the stock. When a mega cap enters a major index, every retirement fund tracking that index is legally forced to buy it. If you have money in a retail superannuation fund in Australia, this affects you. This was supposed to juice the valuation. Instead, it is depressing it. Since entering the index, SpaceX share price has fluctuated wildly, and as of the time of recording this video, has tanked below the IPO price. The mechanical buying demand failed to prop up the artificial market. But here's the most dangerous part of this story. Right now, only a tiny fraction of shares are actually trading. The rest are locked up. But there is a staggered unlock schedule which starts on the 8th of August. By December, 40% of the shares will be freely floating. Early employees and insiders are sitting on massive unrealized gains. When these lockups expire, they will cash out. Everyday retirement accounts are the exit liquidity for this manipulation. But if you think that this manipulation is contained to venture capitalists, you are missing the fatal flaw in your own portfolio. This is where the tech crash meets Australian regulatory law. Because this company was fast-tracked into global indices, your retail super fund is structurally forced to hold it. Here is how the benchmark transmission trap works. Comment benchmark transition trap if you're still with me. Under the Your Future, Your Super legislation, super funds are judged on a strict performance test. They must compare their returns against a specific benchmark index. Index providers have a standing rule. A new IPO gets added to the major indices after a seasoning period of 1 year. In the case of SpaceX though, an exemption was made. It was fast-tracked to be included on the 29th of June, just 17 days after its IPO date of 12th of June. because your super fund's international equity allocation is benchmarked against these indices, specifically the MSCI All Country World ex Australia Index, also known as MSCI ACWI. The investment manager must buy the stock the moment it enters the index. You might assume that your investment manager would use this expertise to avoid an overvalued cash flow negative stock. But actually, they are penalized if they do so. If a chief investment officer looks at a stock and decides it is in a bubble, but chooses to underweight it, they create what is known as tracking error, which represents the standard deviation of the difference between the fund's actual returns and the benchmark's returns over time. Under the current regulatory test, tracking error is an existential business risk. If they underperform the benchmark by just 0.5% per annum over a rolling 8-year period, the fund fails the test. They are legally mandated to notify members that they are underperforming. If they fail twice, they are barred from accepting new members. This creates the hugging mandate. Comment the hugging mandate if you're still with me. Therefore, fund managers are stripped of their fiduciary judgment. They're forced to blindly hug the index, even when it is crashing, just to pass a regulatory test. This mechanical transmission channel creates a devastating demographic time bomb. Historically, a balanced super fund held a 60-40 split of growth and defensive assets. It was designed to protect your capital as you approach retirement. Under the pressure of the performance test, the definition of balanced has been stretched. Today, most balanced options hold 70 to 80% in high volatility growth assets. They are growth funds posing as conservative investments. Approximately 2.5 million Australians are entering the retirement risk zone right now. This regulatory failure disproportionately harms regional Australians, gig economy workers, and those without access to professional financial advice who rely entirely on default superannuation options. When you transition from accumulating wealth to drawing it down, you face the decumulation death spiral. Comment decumulation death spiral if you're still with me. If the AI bubble bursts and the market corrects in the first year of your retirement, you're forced to sell your assets at depressed prices to fund your living expenses. Those units are permanently removed from your portfolio. You lose the capacity to participate in the eventual market recovery. Actuarial studies show that this can exhaust your retirement capital up to a decade earlier. The performance test is a strictly time-weighted accumulation phase metric. It completely ignores the cash flow realities of retirees. It forces pre-retirees to hold the exact kind of high volatility, bubble-prone assets that will trigger sequencing risk right when they need capital preservation the most. We cannot rely on a single metric index replicating test to manage a $3 trillion retirement system. The index methodology of third-party providers should not act as the de facto investment strategy for Australian retirees. Australia must adopt a multi-metric framework. APAC 2100 has made a formal submission to the Treasury. Comment YFYS if you'd like to read the full submission. We must evaluate funds on implementation efficiency, risk-adjusted total return, and peer relative outcomes. This stops the toxic incentive of blind benchmark hugging. We must implement proper benchmarks for emerging assets. This stops funds from being forced to over-allocate to volatile listed tech just to pass the test. We must decouple accumulation from decumulation. Retirement products require bespoke testing that evaluates money-weighted returns and downside projection. The stock market is a symptom of a broader AI bubble, but the transmission mechanism of that crash into everyday retirement accounts is a failure of regulatory design. We must fix this architecture before the baby boomer drawdown phase peaks, as this would result in a retirement crisis all over Australia. If you want to see the exact policy directives that we are proposing to fix this, check the description below to read the full submission by APAC 2100 and share it with someone who is concerned about their future.